market completely under pressure, but look at the recovery. It's 100 points recovery from lower levels, guys, and predominantly because of IT space. But couple of names adding to this recovery is Bharti Airtel, which is up by 5%, and we know the kind of weightage the stock carries, and also ITC helping market to stay higher. Look at the theme of stocks which have moving higher today and which are moving lower. Stocks which have been underperformers, stock which have been laggard, stock which had lot of short positions. Those stocks have not done well, and we are seeing those stocks bouncing. But stocks where maximum bullishness was there. Case in point, HDFC Limited. You can also see some of the private sector banks. These stocks are not doing well in today's trading session. But the best part is that we are not seeing continuity in the fall, and hence all those stocks of market crashing and probably big selling coming off. I think at least as of now it should wait. Let's take it ahead, Nayantara, with our experts who are joining the show.
That's right. So let's get to the market veterans that we're getting you here on ET now. It's not fair to blame the long-term capital gains tax, the reintroduction of it. It's the global doom also that you're seeing that are triggering a sell-off in our equity markets. This is just a short-term blip, or is there more pain ahead? What exactly should be your strategy in these volatile times? We get you leading market experts to help you make your decisions.
The good part is that FIIs are still net buyers in our market as of the yesterday, and probably this time the corrections will be more in kachra stocks, non-quality stocks, whereas the large caps and some of the quality mid caps, while they can correct for some time, will provide great opportunity to enter. So normally we have talked about SIP in equity because of the volatility, but now the time has come where we have to talk about SIP in debt market because of the volatility. The volatility has arisen for a variety of things. One was the concern about government's fiscal slippage and the excess borrowing program. The second has been the communication from the RBI in terms of comforting the market. The third is the global interest rates which are rising. Put all these things together, fundamentally we think at 155 basis point over 10-year, over repo rate, 10-year government securities provide an attractive option. It is almost factored in 2 rate hikes without actual rate hikes happening. And in the near term, there will be higher volatility. But if you do SIP or STP in income fund, it might provide good entry opportunity.
What you buy is more important than when you buy. So it's not a question of whether you buy 10% down or 10% up. A stock is hitting circuits and it's already down 50%. The poster boy of this bull market went up 20, 30 times over the last 3, 4, 5 years. Vakrangi, we all know it. No recommendation. I'm just explaining it for the sake of a discussion. So you bought it 10% higher, 10% lower. It doesn't make a difference today. There's no exit for you. But if you buy these high quality companies, at least when the bear comes along, you can somersault yourself back into a sand bunker and be safe. So we'd rather be safe behind quality and earnings, and you know what the names are. So investors should give up the idea of getting rich over a few months and weeks. I think you have to buy companies with strong fundamentals. It sounds cliched, but it couldn't have been more important than a time like this. You buy a company, it goes down 10%, 20%, doesn't matter. You can sleep well at night. For example, people say stock market you don't need any effort to make money. But the guy who's put all this money in, and we are people who don't put all our money in, we put all our net worth into stocks. When you have to wait till 12 to look at the Dow and then get up early at 4 o'clock to see what the Nikkei is doing, if that isn't effort, I don't know what is.